Tax Torpedo, many people say that the 401k is a very good retirement tool. But when the unstable economic environment and the government debt rises, and also the stipulation of RMD in 401k, many people don't understand why RMD can make such a series of issues. What is RMD? Require minimum distribution. It is the rule that when we reach the age of 73, every year we need to withdraw a certain amount of money and pay taxes. In addition, the percentage of withdrawal increases year after year. It increases your taxable income. It may further make your Social Security income taxable. It also the extra charge to your Medicare Plan, Part B and Part D. When stock market crashes, plus the mandatory yearly withdrawal, the loss may take years to recover. What are we facing now? This year is 2026. Our national debt is over $39 trillion. We need to pay social benefits and medical expenses. How will the government cope with such issues? The answer is printing our money and raise tax. If you put most of your money in 401k, 403b, IRA, you are making a big bet. Do you really think that your taxable income decreases in your retirement years? Please don't forget that you almost pay off your mortgage, your children have grown up, you do not have any deductions for mortgage interest or raising children. You can no longer put money into 401k, HSA 529 to defer taxes. In your retirement years, you may have 401k as income, other rental income, stock dividends, SSI income. Also, don't forget inflation. It means that the amount of your withdrawal may increase sharply.
It's a stealth tax. But we've already paid for that. Yeah, they call it the stealth tax.
With inflation this high, we might have to start taking more out of the 401k.
I was afraid you'd say that.
RMD require minimum distributions. It does not care whether you need that money, and it does not care whether it is a bull market or a bear market. It is mandatory that you must withdraw money and pay tax since the age of 73. If you don't comply, the penalty is 25% of the amount not taken. Don't forget that you have a withdrawal from RMD, you have rental income, or you may have a stock dividends and SSI. You may easily your tax bracket from 12% jump to 24%. The RMD income will induce a dramatic spike in marginal tax rates for retirees. It occurs when other income falls up to 85% of SSI to become taxable, creating a high hidden tax rate. Marginal tax rate, often described as a tax bomb or simply an unexpectedly high marginal tax rate. It never says that 401k is less desirable. It's just traditional savings strategy may need some enhancement. We need to consider our tax landscape and our risk of longevity. A quick shift of your perspective can save you tens of thousands of dollars. You may say, "Oh, are you exaggerating?" No, I can show you how the money adds up. When your tax bracket rises above 22%, for every extra $50,000 income, you need to pay extra tax $11,000. For the federal Medicare surcharge, it can range from $2,000 to $5,000 more. As for Social Security income, if your income is over $44,000 a year, 85% of your SSI is taxable. If your tax bracket is above 22%, that means the tax you paid is over $7,000. The money in 401k, 403b, IRA is all exposed to market volatility. Once stock market crashes, like 2001 and 2008, within a very short time, 30 to 40% of your money can be gone. I quote an example. If you retire at 65, you go to heaven at 95. During these years, if you have higher taxable income, higher tax brackets, and you need to pay extra tax on SSI and pay surcharge on Medicare, if each year, if you paid $10,000 or $15,000 more taxes for 30 years, do you paid almost $500,000 more? For widow penalty, many people don't want to talk about it, me either. I just want to mention that in America, the tax policy may not be so friendly to single people. Every year, I would like to spend $10,000 to $20,000 for vacation. Every 5 years, I would like to buy a new car. And I also like to sponsor my grandchildren's education. But if I withdraw more money from my 401k, it will push up the taxable income. What causes the problem? The problem is that most of the money is being put in the deferral account like the 401k, the 403b, IRA. But my CPA didn't tell me. Your CPA is only to help you file the tax correctly. When you want to manage your money effectively and guarantee better retirement income, you need a licensed financial professional. Many people already silently transfer part of the money from tax-deferred account to tax-free account to avoid the possible high tax in the future. That way, when they retire, they really have lots of freedom. Can you tell us some methods which can lower the risk caused by RMD? Yes, sure. To be fair to everyone and prove that it is not scam, all the methods can be searched online, and I Googled some and put it here to show you. The first method is Roth conversion. Every year you can transfer the part of the money from 401k to the Roth account, but be careful, you cannot transfer too much a year because it will add to your taxable income that year. The second method is donation. It will deduce the amount of money in your tax-deferred account. The third method is transfer the money to a special type of annuity called QLAC. By the law, everyone for their whole life The maximum transfer amount is $210,000. People can defer their tax and start to pay tax at the age of 85. QLAC guarantee lifetime income and also can defer the tax till the age 85. There are several different types of annuity, most of them using index investing. That means you won't lose any money even the stock market crashes. Some companies give new account bonus and guarantee 12 years good rate. I know that my coworker rolled over a lot of money from 401k and 403b into annuity. I have never heard that there is any limitation on it. What you said is true. For other types of annuity, there is no limitation. But for QLAC, because it has the function of tax deferral till the age of 85, so it has amount limitation. The fourth method is a special type of life insurance with cash value. It not only offers protection, but also an outstanding tax management. Above all, it is leverage can increase your family wealth. You may say that it is the money after death. Not exactly. If anything happened to you, it can turn into living benefits. I also bought it myself. It also has long-term care rider. When we get old, when we need long-term care, we can use that money. IUL Index Universal Life Insurance, it is better for us to prepare it when we are younger. The premium will be better. At the age of 72, insurance companies is no longer to offer any. For me, I prepare very well for my family. I bought my own IUL. When I'm gone, my two sons will have enough money to buy their own residence. American government allowed IUL holders enjoy the many tax benefits. For example, the life insurance together with the cash value worth $1 million, when passed to your family, it doesn't need to pay tax. It's saved tens of thousands of dollars already. Some people say IUL is rich people super bank. They use compound interest and index investing. If people want to use money, they can borrow from their own cash value account. In America, borrow money, you do not need to pay tax. Then do I need to pay it back? If you don't pay it back, it's okay. It will be deducted from your debt benefit. That way, you can withdraw the money from your cash value account to go for vacation or do anything or buy a new car without restriction. I am licensed financial professional. If you have any questions about annuity and IUL, please feel free to leave a message to my phone and I will call you back very quickly. I'm also a licensed Medicare sales agent. If you or your friend need my service, please feel free to leave a message to my phone and I will call you back very soon. Again, guarantee free service.